Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I'll be taking you through how to account for revenue grant. Let's look at the question. The requirement says show how the grant will be accounted for in the first year. Now let's see the details. Now Joy Limited received a 10 million grant from government for the employment of young graduates. The entity incurs total wages cost of 15 million over 3 years. Joy intends to engage these graduates for the next 4 years. The grant condition is for Joy to keep these graduates for 3 years. And what it means is that the grant condition will be met. So, and of course, before the grant will be recognized, the entity have to be certain that they will meet the grant conditions. And this is a revenue grant towards wages cost. So we have 15 million for 3 years. It means that is 5 million per annum. 5 million per annum. That gives us 5 million per annum. What it means is that the grant will also have to be spread over the period. So, the period of the cost. And this period of the cost happens to be 3 years. So, the grant will be divided by 3. Let's see. So, 10 divided by 3. That's 3.3 million per annum. Now, for revenue grant, the entity have 2 choices to make. To decide between 2 choices. So, 1, account for grant as other income. And then 2, account for grant as a reduction to costs or to related costs. Just to keep it simple. So for the first choice, that is accounting for the grant as other income. So I will show how we account for the 2. It means that in the P&L, please take note. In P&L, the entity would have other income. So what will happen is that as part of the wages, so you would have the wages, which is 5 million, and then you have separately other income, and that will be 3.3 million. Now, if it is as a reduction to costs, it means that in the P&L, we would have the wages here. That will be 5 minus 3.3. So the reduction in cost would be 5 minus 3.3, and that will be 1.7. So the net effect in P&L is the same, because look at it, this is cost and this is income. Or if you want to look at it the other way around, you see this as cost, and this will be cost as well, but this is income, so positive. Now, the balance in grant account would be, at the end of the first year, will be 10 minus 3.3. How much was released? So 10 minus 3.3 This is 6.7. Now this would be shown as a deferred income or deferred credit. So this would be a deferred income as part of the liabilities. But the separation is that because we are looking at 3 years, the next year would be current liability. It will be part of the current liabilities. And the remaining last year, which would be 3.4, that should be non-current. Non-current liability. And again, let me just elaborate on what happens when the grant is received. What is the double entry? So let me just note it here. Double entry, which is at initial recognition. They will debit cash or bank and will credit grant. So 10 million, 10 million. And in the subsequent measurement is where you will be seeing that, particularly at the end of the year. So at year end, you see that they will release a bit of it. So they will debit a grant, which is the first release 3.3, and they will credit P&L or the related cost, which is wages, 3.3. And this is how the double entry will look like. Great. So this is how we account for revenue grant. Know that there are two ways of accounting for the grant. It's either accounted for as other income or it is used to reduce the related cost. Whichever way the entity so chooses to use or adopt, the net effect in P&L is the same. So here you have 1.7, which is debit or charge or cost. Here you will also have 1.7. I hope this helps in your preparation for the FR exam. Please subscribe to this channel to receive updates on new videos.